Money completely controls our world, yet the financial system is intentionally designed to be confusing. Take a look at these 10 questions. You've probably asked yourself at least one of them. Today we are stripping away the complicated jargon and simply explaining the financial questions everyone has. Why isn't $1 equal to €1 or 1 Japanese yen? It's because currencies are essentially shares in a country's economy, and their prices are driven entirely by supply and demand. Imagine you want to buy a German car. To buy it, you need euros. If thousands of Americans are buying German cars, the demand for the euro goes up, making it more valuable compared to the dollar. Furthermore, exchange rates are influenced by central bank interest rates, inflation, and political stability. If a country is printing too much money or facing an economic crisis, investors sell off that currency, dropping its value. There is no global standard price for money anymore. A currency is only worth what someone else in the global market is willing to trade for it. If you look at global economics, almost every single country on earth is trillions of dollars in debt. But national debt isn't like your personal credit card debt. When a country wants to build highways, fund a military, or invest in education, it often needs more money than it collects in taxes. So the government issues bonds, essentially an IOU. Investors, banks, and even other countries buy these bonds, lending the government cash in exchange for a small amount of interest over time. As long as the country uses that borrowed money to grow its economy faster than the interest rate it owes, debt is actually a powerful tool for growth. It only becomes a crisis when a country borrows recklessly and its economy stops growing to pay it back. If a country is in debt or people are poor, why can't the government just turn on the printers and give everyone $1 million? Because money itself has no intrinsic value. It only represents the goods and services that exist in an economy. Imagine an island with 10 cars and $100 in circulation. Each car costs $10. If the government prints 1,000 more dollars, but no one builds any new cars, the car dealers will simply raise the price of the cars to $100 each. This is called hyperinflation. Printing money doesn't create wealth, it just dilutes the purchasing power of the money already in your pocket. Historically, countries like Zimbabwe or the Weimar Republic tried this, and it resulted in their money becoming completely worthless paper. To understand Bitcoin, you have to understand the problem with traditional banks. Currently, if you send money to a friend, a centralized bank acts as the middleman to verify the transaction. Bitcoin replaces the bank with mathematics. It is a decentralized digital currency. Instead of one bank keeping the ledger of who owns what, thousands of independent computers around the world hold a copy of the exact same public ledger, called the blockchain. Every transaction is verified by this network, making it nearly impossible to hack, fake, or control by any single government. And unlike traditional money, which governments can print infinitely, Bitcoin has a hard-coded mathematical limit of 21 million coins, making it a digital asset driven by absolute scarcity. We all hate inflation because things get more expensive. So wouldn't negative inflation, called deflation, be great? Actually, it's an economic nightmare. If prices start dropping across the board, consumers realize that a car or a house will be cheaper next month, so they stop spending money today and wait. Because nobody is buying anything, companies stop making money. When companies stop making money, they fire workers. When workers lose their jobs, they spend even less money, causing prices to drop further. This creates a devastating deflationary spiral that is incredibly hard to stop. This is exactly why central banks aim for a slow, steady 2% inflation rate. It constantly incentivizes people to spend and invest their money today, keeping the economy moving.
Politicians love to say, "We are going to put a massive tariff on foreign countries, and they will pay us billions." This is a fundamental misunderstanding of how tariffs work. A tariff is simply a tax placed on imported goods. The foreign country does not write a check to the government. Instead, the domestic importing company pays that tax at the border. But the importing company isn't going to absorb that loss. They simply add the cost of the tariff directly to the price tag of the product. So, when you go to the store to buy that imported washing machine or electronics, you are the one paying the higher price. Tariffs are ultimately a tax paid by the consumer.
The housing crisis isn't just in your city, it's a global phenomenon, and it comes down to a perfect storm of supply, demand, and cheap money. Following the 2008 financial crash and the recent pandemic, central banks dropped interest rates to near zero. This made borrowing money for mortgages incredibly cheap, flooding the market with buyers. Demand skyrocketed. At the same time, restrictive zoning laws, lack of land, and high material costs meant we simply weren't building enough new houses to meet that demand. When you have record high demand and record low supply, prices explode. Throw in massive Wall Street corporations buying up single-family homes as rental investments, and the average family is completely priced out of the market. People use these words interchangeably, but they are completely different psychological and financial strategies. Investing is buying an asset, like a piece of a business or real estate, and holding it for years or decades. Investors don't care about daily price drops. They care about the fundamental long-term growth and profits of the company. Trading, on the other hand, is about taking advantage of short-term market volatility. Traders buy a stock and might sell it an hour, a day, or a week later. They don't necessarily care what the company actually does. They only care about chart patterns, momentum, and predicting what other buyers will do next. Investing is like buying a farm to sell the crops every year. Trading is like buying the farm just to flip it to someone else tomorrow for a quick profit. Most people are taught that all debt is bad, but the wealthy view debt as a tool. Poor and middle-class people usually use debt to buy liabilities, things that lose value, like big TVs or luxury cars. The rich use debt to buy income-producing assets. They borrow $1 million from the bank to buy an apartment building. The tenants pay rent, which covers the monthly bank loan, plus a little extra profit. The rich person gets to own $1 million asset using very little of their own money. Furthermore, billionaires use a strategy called buy, borrow, die. Instead of selling their stock and paying massive capital gains taxes, they simply take out a low-interest bank loan using their stock as collateral. It gives them tax-free cash to live on while their assets continue to grow. If a criminal makes $1 million selling illegal drugs, they can't just walk into a bank and deposit it. The government will immediately ask where the money came from. That dirty money needs to be washed. Money laundering is the process of making illegal cash look like legitimate income. A classic method is using a cash-heavy business like a laundromat, a car wash, or a restaurant. The criminal takes their illegal, dirty cash and secretly mixes it into the cash register, pretending they just had a lot of legitimate customers that day. They declare this inflated revenue to the government, pay the required taxes on it, and now that money is clean. It can be legally deposited into the banking system without raising any red flags. The financial system is a game, and like any game, if you don't understand the rules, you are going to lose. Whether it's understanding how inflation eats your savings, how debt can be weaponized, or why prices are rising at the grocery store, financial literacy is the ultimate defense. The more you know about how money flows, the better equipped you are to capture it. If this video cleared up some confusion for you, hit the like button, subscribe for more financial breakdowns, and I'll see you in the next one.